Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by Alan Higgins. And making his debut on Need to Know this week, we've got Coutts UK equity expert Richard Way. Now, each week on the podcast, we look at the three things investors need to know. Now, that might be for the week ahead, as well as longer term trends. And we read the research so you don't have to. But before we get to that and before we have a proper chat with Richard, Alan, a couple of things to catch up on from last week. One thing I noticed, we both read this article today in the FT. There's a lot, we've been talking a lot. Well, let me rephrase that. You've been ranting a lot about the UK's issuance of index linked debt. And there was a piece that was just come out in the FT about that. And it was a little bit of a justification for it. Maybe they're not as bad as you say they are.
Bit of PR in there. Yeah. Hi, Sarah. Hi, Richard. We'll talk in a minute. But yeah, it's nice to start the podcast with a bit of a rant. So I take issue with it. I mean, basically, there was also an article in the Telegraph, which was much more critical. We talked about the outsized nature of the inflation-linked market in the UK first. Nice to be first at something, isn't it? It's basically circa 25% of the debt market, more like 7 or 8% of the United States, for example. And yeah, there's a little statement at the end of the FT article. On balance, it was probably okay. Well, I'm going to put some work into that. But what I would say, reminder, okay, since inflation-linked has been issued, 1981, inflation has averaged 3.2%, okay, till now. So I've checked that. However, index-linked, I know we're getting a bit geeky, uses RPI, and RPI is up to 4%. So I question that. And the other point is, in times of stress like now, when we could really do without that extra spending on interest, and as it happens today, we had the debt numbers. They were worse than expected. Guess what? 2.5 billion more on debt interest. Yeah. Inflation linked, RPI. In times when times are tough, we're really paying for them. So I question that, but you like to give me homework. I'm actually going to try and do some calculations and challenge the FT on that. Okay. Or rather one of the journalists in the FT. So that's kind of debt rant number one, but a bit of fun debt rant because we talked about US debt as well, haven't we, Sarah?
We have. We've talked a lot about US debt, and we're concerned about how large it is.
Yeah. So someone who I really admire, who has a really good another podcast called Odd Lots, Joe Weisenthal.
Very good podcast.
Yeah, very good one. Almost as good as ours, isn't it?
Almost, yeah.
He said, I bet you could never guess which is the best-selling financial app. And, to put people out of their misery, because you might think, I don't know, something to do with Bloomberg or Financial Times. It is the usdebtclock.org. And I've downloaded it. Okay. And it's quite addictive. Literally, I'm looking at the US national debt go up millisecond by millisecond. But it's got some helpful other areas. So, for example, it shows debt to GDP in the United States is 125.
Okay.
Where it was in 2000, just 24 years ago, 55%. Okay. And also, this is the really concerning. This is what we've been talking about. The budget deficit. So what I talked about before is the stock of debt. The budget deficit, according to the debt clock, and I know this is roughly right, is 6.5%. But this is in boom time. We're supposed to borrow this much when we really need to. Like, for example, 2010 when we were coming out of the financial crisis, we borrowed 8%. United States borrowed 8%. So it's got all these helpful numbers. And it also has debt interest. Oh my God. Interest on debt now, getting close to defense spending. 685 billion versus 828 billion. So look, it's just the interest cost. And you can see it ticking up. So there's a little tip. It cost me £5. I'm not going to put on expenses. I'm going to take it on the chin.
Good. I'm not going to be spending £5 on that.
But despite that, people are buying a lot of debt.
Speaking of which, some more CoCos got issued, didn't they?
Barclays issued. So we talked about UBS coming back to the market. Barclays issued, and there was 13 billion of orders. For roughly a 2 to 3 billion issue. Wow. 13 billion of orders at 9.5%, circa 9.5%. And also gilts. There's been even people are clamoring for gilts. So despite all this debt, investors love it, Sarah. So for now, I think that's good news for fixed income. Fixed income looks well supported. Good for people who own balanced funds, I guess. So that's it on the debt side. Is there anything else that we need to cover that we referencing older programs?
There is actually, because we've talked a lot about Michael Burry, he of The Big Short, because there was a lot of discussion around the fact that he'd sort of shorted. We didn't know exactly quite what he'd done and how he'd done it, but he'd placed another sort of big bet against the US market. We talked about it on Need to Know on the 22nd of August, and again, I think on the 26th of September as well. And I read that he's actually now cancelled those orders. So thoughts on that? I guess, I mean, were we right when we were saying that markets, not when I'm never going to criticize Michael Burry. The guy's an incredibly smart guy and I know nothing. But were we maybe right when we said that markets were a little bit over bearish, and maybe he's recognized that and he's kind of stepped back from that?
Yeah, I think so. I think, we've got to be humble, right? Michael Burry, genius in 0809, absolutely. We recognize that. But it just goes to show all investors get something wrong. By the way, us included, me on record on this podcast many times, as you know, Sarah, wrong. And maybe I'm wrong on this inflation linked when I've done the work. Let me see. So yes, look, we lent again, didn't we? We said no, markets are too bearish, we're more positive. And he did it on options. I actually thought he did options on indices. Maybe I missed something. He actually did options on ETFs. But it's
yes, he did, didn't he?
He's particularly bearish on ETFs and index exposure. But he's closed it out. And I mean, good news. I think for the market, he's a practical guy. Look, he's made good money, but I think I suppose we should give ourselves a very small, with great humility, pat on the back jointly, Sarah, you and me.
I think so. I think probably Michael Burry is going to be right more often than we are. So, okay.
Yeah,
okay. All right then. Right. Well, turning now to the three things we need to know this week. So, Richard, welcome to the podcast.
Thanks, Sarah.
I think I always let Alan, I'm very strict with Alan. He's only allowed three things. So, as we've got you on as an extra one, and when we've had Howard Sparks on, your colleague, not that long ago, I let you have two things, and then I leave Alan with one thing to talk about. But I think before we get to what your two things are, I would just like to know, basically, well, introduce yourself to the audience for those that don't know you. How did you come to be a UK sort of equity expert for Coutts?
Okay, thanks,
in a short sort of 30 seconds.
Yes, thanks very much. Well, thanks for the invite, firstly. So it's nice to be here. I mean, I've always been with Group. I started my career right at the bottom many years ago. My friends were the post office, the franking machine, I think the photocopy and the fax machine. So I came up through the portfolio management side, several years doing that, and then sort of was servicing high net worth clients from a portfolio management perspective, and crossed over probably onto the research side in the early 2000s. Had a spell doing Asian and Japanese equities, which was pretty exciting in the high days of China, sort of, being the workshop of the world. And basically crossed over to do, again, sort of focus on UK equities probably for about the last 10, 15 years. So, the grey hairs are showing a little bit through market experience, but reasonably sort of varied career, even sort of though I've been with Group all of the time.
Brilliant. Okay. All right then. Well, I'm guessing then that your two things are going to relate to UK markets, aren't they? So just give us high level, just what are the two things, and then we'll go into them in a little bit more detail.
Yeah, sure. I mean, obviously, that's my area of expertise. So I think I'm just going to sort of frame some selective opportunities at a high level in terms of the UK market, which generally has been a little bit out of favour, as we know, for some time. And equally, hopefully it's not too early. I mean, we're sort of mid-November there. We're sort of going to talk about that topical theme of the year-end rally, or the Santa rally, which is always quite good fun.
Good. And then Alan, what's going to be your point? Because I think it's going to sort of relate to a little bit what Rich is talking about, isn't it?
Yeah. Well, given it's a bit of a UK theme, I think we'll have good fun talking about the Santa rally, though, Richard. I think we've both read this UBS report, which we're going to talk about, which is comparing the valuation of UK stocks, particularly with US stocks, on a real like-for-like basis. So digging deep into, what's really going on when you compare UK stocks versus US or other stocks, and kind of related to that, I couldn't talk about the UK without talking about the FTSE 250. So the next 250 stocks, because even some very well-versed investors are surprised when I explain to them how well the FTSE 250 has performed historically. And it's so out of favor at the moment, maybe for the right reasons, but just a reminder of how strong that performance has been, at least over the long run.
Okay, brilliant. All right then. So Richard, over to you then. Your first point, you want to talk to us a little bit about the UK market. And I guess, we're going to talk about this UBS research, but it's been a little bit unloved, hasn't it? Probably since Brexit, I guess.
Well, I think even before then, to be honest, Sarah, when you sort of look back at the charts and look at how UK equities have performed on a relative basis to global equities, we seem to have sort of been in this lost decade, probably 2009, maybe through to 2019. And I guess that period is really framed by the fact that investors were really focused on growth. And equally, we were in a low interest rate environment post the global financial crisis. So there was a cheap cost of capital that fueled that sort of direction of where people were focusing. Since then, really, we have seen a bit of stabilization. The pandemic in particular has seen a sort of a bottom to that sort of relative underperformance. And I suppose that's really where I'm sort of going to come from in terms of, are we potentially seeing some selective opportunities? There's a valuation argument coming back in for UK stocks because they are cheap. We'll get into some numbers in a minute. And on the basis that, they are in a sort of contrarian position almost. The latest Bank of America survey, the Global Fund Manager survey that comes out every month, continues to show that institutional fund managers are underweight UK equities, and by some margin as well relative to historic levels.
Yeah, and we've certainly seen that with UK pension funds, aren't they? They're investing a lot less now in UK equities than they have done historically.
Yeah, that's absolutely correct. Yeah. The issue really around the UK is that, I guess for want of a better phrase, we don't have those really sort of interesting or sexy sectors anymore. Magnificent Seven, well, what have we got in the UK? Maybe the famous five. You think about those stocks that probably everybody knows in the UK, which is Shell, AstraZeneca, HSBC, Unilever and BP. They seem to have been the five top names sort of that dominated benchmarks for some time now. So, but the sort of flip side of that is that, the sort of importance that they've got within the benchmark and the fact that sort of valuations are looking very cheap, and we've got some sort of pretty attractive dividend yields that come with those stocks, should sort of resonate with investors at some stage. So, I think that's really where you could sort of focus.
And also that we're going to talk about valuation, obviously, when we talk about the UBS report, but it's that sort of PE ratio where we're seeing perhaps, we're not giving advice here, but that we're seeing very kind of cheap stocks in the UK compared with the US, aren't we?
Sarah, can I jump in?
Yeah, of course you can.
Just on pension funds, just to clarify, pension funds, to be fair, yes, you're right, they have reduced UK equities, but they've reduced all public equities. They're very, very light in public equities. And nearly all of this is in the public domain, in the sense that they publish their equity weightings. I'm seeing equity weightings down at 10% and they tend to be more global. And let Richard go on cheap, just to give a bit of balance. Yes, UK equities are cheap, but so are European equities, emerging market equities, Japanese equities. But just to show we are more global. But over to you, Richard. Show how cheap are UK equities really?
Okay, well, I'll give you two numbers, Alan. So forward PE ratio of the FTSE 100, 11 times, and the forward dividend yield is 4.5%. I think actually when you look at the breakdown, on a market cap weighted basis, something like 50% of the FTSE 100 is on a sub 10 times PE going forward. So that sounds pretty cheap, doesn't it?
It does, to be fair. You can find those kind of valuations elsewhere. And I suppose this leads to the wider debate. Is it because, Richard, the UK basically is a value market alongside a lot of Europe. Well, outside of France, we know France has got the LVMHs of the world. I know you know that company very well, and a few other growth companies. Is it fair to say, at least in the 100, we can talk about the 250 later, it's very much value orientated, a bit like big parts of Europe?
Yeah, I mean, absolutely. I mean, that's the real sort of breakdown of the benchmark, that we're heavily weighted in energy. BP and Shell, I think, are about 16% of the FTSE now. There's a big proportion in banks. So, I think the nearest thing we've got in a large cap name that would have any sort of technology angle to it is probably RELX, which is the big database management group with the decision tools. And they've been using AI for years, actually. So, that's the closest we've got. And that's probably the 10th largest stock, whereas obviously the top 7 in the US are all technology names, and they're 30% of the benchmark.
Yeah, fair. Okay, and what about this? Because we'll both cover this quite interesting UBS report. Others have done it. So quite a few firms have done so-called sector neutral valuation. So if you think of it in simple terms, that means virtually taking the tech out of the US and comparing, if you like, oil companies in the US versus oil companies in the UK. So comparing BP and Shell with Chevron and Exxon, but UBS taking it a step further, it's fair to say. And Sarah always says we read the research, you don't have to. What do you think of this research? Because on the face of it, it seemed to say, well, 40% of the companies actually are equal or even higher rated than the US counterparts. But I think you look at it a little differently, don't you, Richard?
Yeah, I must admit, I read the article. I mean, although admittedly we haven't got obviously access to the data that's beneath it, they may be looking at different metrics, etc., from a valuation perspective. But I struggled a little bit to sort of come to the same sort of conclusion. So, you're absolutely right around sort of comparing the oil stocks maybe as an easy sort of one to do. But BP and Shell, I mean, actually are far cheaper than Chevron and Exxon. I think Chevron and Exxon are probably on about a 50% premium if you're looking at a PE ratio, one of the simplest valuation metrics. I mean, arguably you can find companies that are very, very similar. I mean, I've got sort of a couple of examples I can give you, which equipment rental businesses. So Ashtead, the Sunbelt brand that we see now in the UK, they've got a peer in the US, which is United Rentals. Very, very similar businesses, huge footprint in the US market. If you pull the two sort of metrics of valuation data together, they look almost exactly the same. And I guess probably in the sort of defense industry, BAE Systems versus Lockheed Martin. Again, two examples where probably the valuations are very similar. But I struggle a little bit to find anything that really sort of links a higher rated stock in the UK versus the US, I must admit.
Is it a question then of, I mean, and we talked about this a little bit before, is it a question of if you look for data, and there's a bit of confirmation bias going on, if you look for if you're very selective about what data you're using, you can pretty much find whatever you want to kind of support your argument, can't you? And that sounds a little bit, maybe, as you say, we don't know what the numbers are underneath, we haven't looked at them, but it suggests maybe there might be a little bit of selective sort of use of data here to perhaps support an argument.
Well, yeah, I mean, that could well be the case. I think, it's something that we're always trying to sort of ward against, having that sort of unconscious bias to sort of decision making and, looking for something to frame the argument that we're trying to create. I mean, admittedly, I've sort of only sort of cross-checked the sort of the larger cap stocks because that's where we're focused. Maybe sort of digging into the sort of, the more mid-cap names, you may get some sort of comparisons. But it's a huge field of data that they've obviously taken a long time to look at, and we'd have to do some further analysis to sort of do some more cross checks on it. Really,
we're in danger of straying into Alan's third point, but we will come back to this. But is it fair to say then at the moment, and again, this is not a recommendation, that if we look at how the FTSE 100 stocks are valued based on forward earnings, they're cheap, generally speaking, they're cheap compared to their US counterparts? Is that a fair summary?
Yeah, I think so. I mean, definitely, the headline index numbers suggest that. And, we have seen evidence that, companies themselves are trying to sort of obviously take advantage of that, given that, they're switching their listings over to the US on a primary basis. And we had Ferguson last year. CRH has just done it in September. They're awaiting a new US listing. And I think Flutter's probably the next one that's going to follow suit. So there's obviously a rationale for going in that direction. Admittedly, they're trying to sort of align perhaps their shareholder base to their activities at the same time. But, generally speaking, I think, you're right. It's a value focused market in the UK. There's selective opportunities that could get recognised, in terms of, better economic backdrop, softer bond yields, etc. It could be a sort of a period where we finally get some sort of better traction in UK stocks, however small that time frame may be.
And obviously a key factor is that we don't have that big growth sector that we have in the US, where we see the Magnificent Seven dominating.
Absolutely,
that's the US indices. Okay. Anything you want to add on that, Alan, before we move on to?
I think that's fair. I would just also make the point that, from an international perspective, Japanese equities have these characteristics in particular. So do certain European and Chinese stroke emerging market stocks. But I think Japan is an interesting market. So it's not just the UK, I would say, but I think fair.
Yeah. Okay. So then let's move on to your second point, Richard, which is about sort of seasonal rallies in markets, and particularly because it's nearly that time of year. We're not quite in December yet, but the so-called Santa rally. And why is that? Is there any kind of data that shows that this is actually something that does happen on a fairly regular basis, and what might be behind that?
Well, as we alluded to a moment ago, there's always data, Sarah, that we can go back and have a look at.
Exactly.
So I've done exactly that. I mean, I've gone back. Bloomberg's has got a great function where you can pull up a seasonal heat map and you can go back over the last 20 years and you can see the monthly returns over those last 20 years. So actually, the average performance for UK equities, and we're looking at the FTSE and 100 again here, for the month of December is pretty much bang on 2%. So the average monthly December return over 20 years has been 2%. I guess the frequency is the next argument that we need to look at is, is that what's the spread of sort of results that we've got here? I mean, surprisingly, in the last 20 years, there's only been 4 occasions where we've had a negative return in December for UK equities. So there obviously is some seasonality factor going on here. I think there are some instances where the data has been a little bit skewed. More recently, you think back to sort of obviously what we've seen in the broader economy. Christmas came early in November 2020 because we had the breakthrough of the vaccine for COVID. So we had a sharp rally in November, and that also carried on into December. But I mean, last year we obviously had dislocations within the bond yield market post that Trussonomics period, and we had a sharp increase when bond yields softened in equity markets in November then, but that didn't follow through in December. So it's not a given, but it tends to be sort of a trend that we see, and there's always this sort of focus on it by the media and markets as well. And I guess it's because we probably got most of the data out of the way from Q3 earnings season as well that people are sort of repositioning, having had all of that information to digest.
Yeah. And Alan, I know you've got some theories on why we might see a Santa rally. I hope it's not widespread.
No, I think we have mentioned before. So I think Richard's quite right. Not just Santa, but also a January effect and these strange seasonals that we have. And it's not just the UK market; it's global markets, it's equities, and to a certain extent, risk assets, high yield bonds, etc. And go back to the start of my career. Sarah, do you remember when I talked about the start of my career? My graduate training, 2 weeks of sitting next to someone, and then off I go trading. Although my boss did get in touch and say recollections may differ. That's when I worked at Sun Alliance, and I always remember we were given budgets, and put in 500 million a year into gilts, 300 million into US equities, and the equity guy, Michael, long since retired. It used to amaze me. He'd do nothing all year. That's not fair. He'd do lots of reading, lots of research all year, but hardly invest anything. Dare I say, maybe a bearish bias. Then come December, and even then, management come down to him and say, Michael, you're supposed to put 300 in. You've only put in 20. You've got to put 280 in December. Get on with it. So he'd be going crazy in December putting the money in. I'd like to think this doesn't happen anymore. For listeners, this doesn't happen at Coutts. I can guarantee that. Okay, but that's one example of going back many, many years. This is 1980s insurance company of a December effect. But otherwise, January. This is quite interesting. Apparently, we'll have to test this. People feel more optimistic at the start of the year, and equities being an optimistic asset, growth asset, people put some money to work in January. I don't know, Richard, have you come across that before?
Well, I was just about to say that the data says beware of the sort of January hangover, Alan, because if we go back to that UK data set and look at the numbers for January, there's actually the average January month is -1%, and there's only 7 years where we've had a positive outcome. So
that's much worse than US equities. So a bit of research. I better do some US equity January effect, because there's definitely a January effect on US equities. So maybe there's some arbitrage here. There's a negative UK effect and a positive US effect. So I have heard that before, but obviously us being in the UK actually wouldn't surprise me, because we are very gloomy here in the UK. We're always gloomy about the outlook. Maybe it's not just a US phenomenon, but that's something that we'll have a look at. It's more homework for Sarah to give me. But yeah, it's an amazing thing. So December strong. Richard tells us UK equities, and I know US equities. So January, allegedly, Alan's telling you US equities as well, but Richard's telling us definitely at least the last 20 years, UK equities no.
Oh, okay. So what we're saying then is there is such a thing then as a Santa rally. It could be a number of factors behind it, but certainly the research you've done, Richard, over the last 20 years, if we look at the FTSE, I should say, there's only been 4 times out of the last 20 years when actually December has been a month for negative returns. Is that fair to say?
Yeah, absolutely correct. Yeah.
Okay. And it could be a combination of a little bit of exuberance and optimism going in towards Christmas, or it could be potentially slack, perhaps slightly inactive institutional investors. I don't think that happens
anymore, Sarah.
No, we don't. We sincerely hope
not.
Surely
it doesn't happen anymore.
Yeah.
Okay. All right, then, which brings us then, Alan, to your last point. I know, Richard, you're going to have some thoughts on this. We've sort of started talking about it already, but this discussion around UK valuations, and as you mentioned, Richard, there's a lot of companies that are looking to list in America. And I saw there was actually an interesting interview with David Schwimmer, head of the London Stock Exchange Group, who has his own thoughts and thinks it's a myth, which I suppose he would do. But I don't know, perhaps, Alan, I mean, hopefully you have read the research. Thoughts on this piece by James Arnold then about
from UBS. I think it's a well done piece, and as Richard said, I'm with him, especially when you compare the oil majors. The oil majors are a real clear comparison, BP, Shell versus Exxon, Chevron, and I think that's a very fair comment about the premium. But I suppose the balance to this research, and I think we have almost covered it, is I think it is fair when you compare truly like with like, it tends to disappear. And there is logic in that, in the sense that, okay, there's less money going into UK equities, but global investors will look at UK equities and look at their prospects alongside European, US, etc. And so if they are better, you'd expect them to be bought. Now, I admit with Richard, that hasn't happened in certain companies. But yeah, this piece of research, I think, is valid. And I'd just make a wider approach, because Richard mentioned the 250. Because if we want to talk about, Richard talking about the FTSE 100 being out of favour and contrarian, the FTSE 250 has been a really horrible performance. So that's the next 250 stocks. But I wanted to remind people just how strong the performance has been. And once you go over long periods, we talk about, basically, it's the truth, there has to be earnings. So I've got the last 30 years, for example. The last 30 years, S&P 500, FTSE 250 earnings have grown by 8%. The 100 has only grown by 3% over the last 30 years, and it was much stronger in the early period. FTSE 100 earnings have struggled to grow, but the FTSE 250, and I think it hits back a little bit about the pessimism that people have about the UK. Again, we're not saying the UK is the most wonderful place, but we do have some good companies under the surface. And it depends when you want to go back to. I've got since 1990. I've got various figures in my book. Since 1990, the 250s returned nearly 11.
Is it fair to say? Sorry to interrupt you, Alan, but is it fair to say that the 250 is the closest we've got to sort of growth stocks? Is that tends to be more what you're seeing in the 250, or are they still value as well in the?
No, much more growth and quality, actually. Richard, you don't look at very many 250, do you? But I think it's fair to say they are quite different characteristics from the 100, right?
Yeah, absolutely. I think, the sector breakdown gives you sort of the answers there, really, that, real estate's quite a big chunk of the FTSE 250. There's a high proportion of industrials where you're going to get that sort of growth element that you were talking about. And equally, there's quite a lot of focus on the consumer as well in the FTSE 250, sort of, on the retail side. So, the success of the FTSE 250 does, to a certain extent, reflect sort of not only sort of, the growth outlook for companies on the industrial side. There's still quite a lot of overseas earnings that come through on the FTSE 250, but also obviously the domestic UK economy.
Is it also fair to say then that the 250 then is perhaps a more domestically oriented market? Whereas we often talk about with the FTSE 100 that the big names are actually really international companies, and a lot of their business, it doesn't even happen in the UK, does it?
Yeah, I mean, I think that's a fair perception. I think everybody's always viewed the FTSE 250 as being the domestic play. But as I said, that there's still quite a big proportion of overseas earnings still there. I don't think it's quite as stark a contrast to the FTSE as it used to be. That gap has certainly narrowed. But definitely, with sort of house builders and what have you within the sort of that index, you're bound to have that focus on the domestic side in the UK.
Okay, so
actually, Sarah, I've got the numbers here just because I think Richard's spot on. So the numbers are, we're going to round the numbers. FTSE 100 is pretty well known, 80% of revenues, circa 80% revenues international. The 250, it's more international than you think. It's closer to 50%. It's a little bit 50% last time I looked. But it's exactly as Richard said, there is some, real domestic house builders in there. Small companies, but there's a lot of very interesting industrial consumer related companies in there. Look, massively out of favor right now for whatever reasons. That's a topic in itself. But it's just when I've spoken to even investment professionals who maybe don't focus on the UK enough, they are very surprised about the long-term historical performance of the 250. And it's also been fair to say, Richard, it's been a happy hunting ground for private equity. So a lot of these companies have been taken out. So you've earned a good return from companies going private, actually.
Yeah, absolutely. Yeah. And then obviously, there's that natural progression still that we get, that companies come onto radar screens as they get promoted to the FTSE 100. So I don't know why there's such a delay on that sort of score. I mean, we'll get the quarterly review out in the next week or so, but there's always that tendency that people only tend to get involved when the companies are so much bigger.
So are we pushing back then against this piece by James Arnold? Then are we saying that actually you can't really compare like with like if we're comparing certainly the FTSE 100 with the S&P, and so it's not a fair comparison?
No, I'm not completely pushing back. I think it's a very good piece of research. And there's an element of selection. No. He still shows UK stocks cheaper on aggregate. I guess the surprise is there's some UK stocks that are more highly valued. So I wouldn't push back completely, but I think Richard, beautifully pulled out two, great examples in the oil sector. That's a very clear cheapness in UK stocks.
Okay, and as I say, we're not necessarily recommending that you rush out and buy UK stocks. But it's interesting to note that they're a little bit unloved at the moment and have been for some considerable time. Thank you very much, Richard, for joining us today on Need to Know. And thank you, Alan. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. So thank you to Alan and Richard for joining me today. Don't forget to check out the podcast page on Coutts.com. And of course, you can subscribe and please review the podcast. Thank you for anybody who has already left a review. I haven't actually looked recently, but I'll go and check that out. You can go and get your subscribe to Need to Know via Google Podcasts, Spotify, or Apple. That's all for this week for Need to Know. Until the next time, bye for now.